Yeah, we'll see. All right, Tyler, we're live. How you doing?
I'm doing good, man. How are you?
I'm doing good. I just went on a ski trip that I don't think I told you about. We went to Colorado, and it was beautiful. I'm more of a beach guy, you know that, but um, we enjoyed it. It was Crested Butte, Colorado. It was beautiful. First
Awesome,
time,
man.
first time there. You doing good?
You're back now. I'm glad you're back now, so we can look at look at a new deal this week.
Yeah, yeah. We can geek out over single tenant net lease. So, do you want to get started now, or do you want to talk? You want me to talk a little bit about the tenant in this situation?
Yeah, talk a little bit about urgent team and just urgent cares in general. I mean, that's your one of your specialties, right?
Yeah. So, most people probably don't know. I've spent the last 7 years basically helping develop single tenant net lease properties, and a big tenant that we've had multiple clients, but is urgent care. We've had several urgent care providers that we've had as clients, and that is kind of how I cut my teeth. Was going out and developing fast-paced urgent cares several years ago. So I have actually seen urgent team around the South. Typically in inline spaces is where I have seen them the most, but they do have some standalone locations. Oftentimes, I believe they were always retrofits, so necessarily not new builds. I'm not 100% sure, but I would suspect that this location will probably be a retrofit into their use, not a new build to suit type deal. So
Yeah,
um,
exactly.
I think they're in probably I would say six countries, not six countries, six states. I believe I know I've seen them in Mississippi. I think I've seen them in Georgia. I know they're in Tennessee. I have one right down the road from me. So they're in several states. I understand that they do operate pretty lean. Like they're very strict when it comes to their real estate. I've never done a deal with them. I have no idea exactly how they work, but I do know that they tend to go into a little bit larger markets. And when I say a little bit larger, there's one in East Nashville here, so they'll go into kind of um, metro areas. And I think what we're looking at here is in Hoover, Alabama, which is quite a bit of difference than Nashville, Tennessee, right? So, but whereas old clients of ours would go into even smaller markets, 7,000 population, etc. So, urgent team again, growing company, not growing super rapidly, is my understanding, but they are growing consistently, and they have been for the last several years.
Yeah, from my research, the family of urgent cares that kind of compiles this group, they only have, I think, only. I mean, they operate 78 urgent cares,
Mhm.
so they're medium size company in this space. Not one of these crazy fast growing 300 400 developments a year companies, but it's not 5 units or whatever.
Yeah,
78 is a pretty reasonable number. So
yeah, good deal. All right, so we've got Hoover, Alabama today. I've never been to Hoover, Alabama. I hear they're good at football down there, but other than that, I don't know much about it.
yeah, me either. I learned about it in researching this urgent cares. You want to share my instead of looking a little bit at the real estate?
Yeah, yeah, let's do it.
Yeah, so as we were just alluding to, right? So Hoover, Alabama is, in the southern, just south of Birmingham. This urgent care is on a main road. I think it's 35,000. A main road between Birmingham and Montgomery, Alabama. I think it's 35,000 ADT. If I'm not mistaken, right along this highway here. This is a very
Good.
retail centric area, right? And as Winston alluded to when he was talking there, this is not a brand new building. This is a rebuild. This lease is meant to start now. I think March 9th is the first official day of the lease. So the lease is brand new on this retrofitted building. And you can see this just by the area, right? Like they're really in the this is really medtail at its best, right? They're really surrounded by QSRs, Publix, all kinds of retail amenities there. You want to? I mean, you have anything else to say about Hoover or this location, Winston?
Yeah, absolutely. So I think Hoover, the town, the population is roughly 100,000. It is a strong community. I do know that. It looks like the population growth is probably a little over 1% annually, so that's good. And in the location, as you outlined before, right in front of a Publix, it's a great location. It's truly a Medtel location. It's something that could be converted to various uses depending on what happens in the future. Love that it's a brand new lease starting out. I think it's a 10-year lease. Love that. So you're getting it on the front end and in a great location. So I think we're starting out in a good market. Not a great market. This isn't downtown Atlanta or anything like that, or downtown Nashville, but it is a really good market in Hoover, Alabama. Great market, great site, right across the street from Publix. So grocery anchored retail and a growing market. So I think that's good. And you're getting the lease on the front end. The one thing I'm a little concerned over is one, I'm reading that the lease structure is a double net. And two, it's an older building. So for that reason, get a little pause, but not much.
Great. Let's have a look at the financials. So you'd mentioned two things there. I'm going to mention a third. This lease, unlike a lot of these urgent cares, medical net lease properties, is only a 1% a year rent bump rather than 2% a year and rather than 10% every 5 years. So, as we'll see a little bit down further here, that makes a big difference. But before we get into that, we can just look at this real quick. So, as we discussed, this is a brand new 10-year lease. It's double net, which means no roof, no structure. Those are included. Those are landlord responsibilities. It's corporate guaranteed by the family of urgent cares. So 78 urgent cares or around that number. That private company is guaranteeing the lease. They're doing 108,000, or they've got 108,000 for year one net operating income, and they're asking for a 6 cap. So the price they're asking right now is 1.8 million.
Yeah. Tyler, I don't want to skip to the end. I know that we've got a chart and data to show, but I would say just looking at it and knowing this industry and specifically this use very, very well, I would say it's priced real aggressive currently. They have increased it from probably 6 months ago. There was a time where these could trade at 5.25 on the low end, but looking at what the lease is, a building type, you do kind of have a shorter term. You see a lot of 12 to 15 year leases in the single tenant urgent care space. And so that's important to note here. I think they're pricing it really aggressive, but I won't try to spoil anything.
No, I agree with you 100%. I think they're a little bit aggressive here, especially because of the 1% bumps. This is something that actually bothered me a bit today when I was looking at that. I was looking at this lease and I saw the 1%, and I wanted to, before we actually go down, I just wanted to bring something up here. So this, if you're ever looking at comparing leases and they have different rent bumps, this is just kind of an overview of how these affect your return. So for a lease like this, where you have around 100,000 NOI and a 6% cap rate, if you have 2% increases, that's an 8% IRR. If you have 1% increases, that's a 7% IRR. And if you have 10% every 5 years, that's a 7.7%. So you can see that for the same cap rate, for the same property, for the same tenant, for the same everything, if they do 1% bumps instead of 2% bumps, you're losing a very significant amount on your return on the back end. And that's not only because of the the lack of rental income, the lack of increases in the rental income during the period. It's because your exit cap, when you exit the building at the end, the disposition cap rate is going to cap the income at that time. So those 2% increases add up, and at the very end, 10 years down the road, when you have an extra 10,000 in net operating income, well, 10,000 divided by 6% is a lot of money, right? Mm-hmm. So you end up losing a lot on the back end because your rent didn't increase in alignment with maybe some other options out there. So I just wanted to. This actually surprised me, and I look at these every day, and this surprised me when I actually just explicitly put the numbers out to see that wow, like if I have a lease with a 1% increase per year, I have to be demanding a significantly higher cap rate than if it's 2%. And how much higher specifically, I've actually got down here, right? So if you run a what if analysis in Excel, which is a simple, hit a couple buttons, you can see that to get the same return on these investments with a 2% increase, if it's a 6 cap, you need to be buying it at a 7 cap if it's a 1% increase. So just just be aware of that when you're looking in the market. You should be about 100 basis points over. You should be buying at about 100 basis points higher if it's a 1% increase than a 2% increase. So,
there's that's really, really good, Tyler. It really is. And I'll tell you, some people that I work with probably won't like to hear that on the development side, right? I think that a lot of folks kind of ignore the rent increases on the development side and on the investor side. It's just it's not one of those main terms that people really kind of harp on too much. So it is very important whether you're the investor or the developer, whether you're the developer, tenant, or investor, to kind of really understand and understand what those increases are going to do for the return. So, way to point that out. I don't think we've discussed that before, and I think that's really good. That's a really good way to do it.
Yeah, I mean that's what I was thinking too. That's why I wanted to make it explicit, right?
Cool.
So back to our pro forma here, right? So we've got some acquisition assumptions, closing fees. As we discussed in the operating assumptions, this is a double net lease. So we have to put some reserve away for roof and structure. I'm using about 5% of NOI for that. The building is being renovated right now. So although it's an older building, it's still having some renovations. So before buying this, we'd want to look into exactly what were those renovations and what maybe is still old about the building before finalizing a number here that we should put away for reserve. You can see the 1% rent increase here that we just discussed. And then here for disposition cash flow analysis, using 2 scenarios. And like I said, this is really where you get hurt with those low rent increases, is when you do your disposition, because the disposition is only on 120,000 in cash rather than say 130, 140. Your exit, your sale proceeds at exit are going to be significantly lower, and you can see that the sale proceeds at exit in this case are actually about the same as what they're asking for the price to buy today. So 10 years from now, you'd be selling that at about the same price. I'm using a 6.5 cap as the exit cap rate assumption. That's a 5 basis points increase per year for 10 years. Just because the building's going to be older, the lease isn't brand new. There's various reasons why the exit cap rate should be at least a little bit higher than the cap rate going in. And then scenario 2, which we didn't discuss yet, is a scenario where this tenant leaves. So at Winston, I mean, as you were saying earlier, right, this is a great location in a very heavy retail environment. So re-tenanting shouldn't really be an issue. The cost of the adaptive reuse we could debate. I don't know if you have more to think about that. How much we'd spend on adaptive reuse in a building like this in a retail space.
Look, that's up in the air. I was asked that yesterday by CFO, and she specifically was like, okay, we just want to, cut out a couple of walls and add some bathrooms and just a little bit of this, a little bit of that. How much is a good budget? And really, there's no telling, right? You don't know until you know exactly what the tenant wants and what they're going to use it for. So I would say putting in $100 a foot there is high. I think it's high. Typically landlords are going to want to do, 25 to 30 or more. So this is being a little bit aggressive, but how long down the line is this? Is this in year 10, Tyler?
Yeah, this is 10 years. Yeah.
So, leave it at 100. We're going to be a little conservative here. Leave it at 100. We'll see what happens. Typically, medical adaptive reuse is a little bit more expensive. You're adding water to each room. There's more plumbing and stuff like that. So that adds up. If they were, in this case, they're going to have to take, maybe plumbing out or cap it in the walls. So you're probably not going to get 100 square foot. If you want to change it, put 70 or so, because you got to realize material labor is going to increase over the next 10 years as well. So, yeah, that's
All right,
my
great. So,
my point. I'm sticking to it.
So for our disposition analysis, we're using a 90% chance the tenant renews and we sell, and a 10% chance we have to do an adaptive reuse. Both of those scenarios are going to get you or basically 1.6 million returned. If you do a weighted average of that, you're looking at about 1.73 million net proceeds on disposition. So to our analysis, right? Assuming 50% leverage, and we can play with these numbers all we want, right? Loan rate 6.5%, 1% loan fees, and then whatever number makes sense for you, right? So so $1.8 million property. If you were in 50%, you'd be you'd need 900,000 in cash. You'd be cash flow positive during the duration of the lease, and then you're getting $1 million back at the end. And again, the 6.5% is pretty much in line with what we're seeing in the market today. That translates to the, at least for me, not so attractive 4.6% levered IRR. This has negative leverage, although the cash flows are positive because, in this scenario, we don't have a massive loan. The leverage is negative because the unlevered IRR is less than the rate of the loan. So you'd really, you'd want to have, if you were to buy this property, you'd want to have the minimum amount of leverage that you have to make the purchase. Because every dollar you borrow to buy this property you're losing money.
Yeah. And Tyler, this is something that we're going to see, especially right now with these changing cap rates. We're going to see this more and more, right? Where leverage really just doesn't work. It just doesn't work. It doesn't make sense. You're only going to you're only going to kind of put down and put out and take on the money that you absolutely need. No more, not a penny more, because it's going to cost you. So personally, I'm, as you know, I'm not a fan whatsoever of negative leverage, but there are situations where it's needed. So
I just wanted to bring this up. So, we discussed rent increases earlier. This chart is the last 6 months comparative sales of single tenant net lease medical offices, closing cap rate versus remaining term. Remaining term here is actually kind of irrelevant. It's almost a straight line across, but they're almost all about a 6 cap in the last 6 months that have sold. So there's a couple of things I think about when I see this. Okay, 6 cap in the last 6 months, fine. However, as we talked about earlier, with the 1% increases, we should actually be 1% above for our cap rate on this property versus other medicals, which typically are 2% a year or 10% every 5 years. So although this looks good on paper, this is a very shallow analysis of where this property should be priced as far as the comps go, because this analysis doesn't take into account what the rent bumps are, also doesn't take into account this is a double net lease versus triple net lease, or an older building versus new buildings. There's a lot of things that don't go into this, which would make me want to put this orange dot quite a bit higher above the line than being right on this line. I think right on this line would be good if this was a new building, triple net lease, 2% rent bumps, and maybe a bigger tenant. But for this tenant in this lease structure, I think we should be up at least in the 7% range.
Yeah. And look, this is right in line. Like I was saying before, there are some of these that are kind of trading in that 5.25 range. We actually haven't had a lot of stock in urgent cares in the last 6 months. Just sold out right before everything shifted, which is really good. But there's a few that's about to come online, and they're in good markets. So I expect it to be priced between that 6 and 7 cap range. This one and the ones I'm referencing to are all at 100% new 15-year triple net leases, right? So they'll be in that 6 to 7 range, probably on the upper end, mid 6s. With that said, this one, as we not to harp too much, older building, It's definitely it doesn't have the best lease structure with a double net lease. And hey, look, I get it. If you're a tenant and you're going into an older building, you're not probably going to want to be responsible for the roof and structure. Totally get that. Negotiate that for tenants all the time. It makes total sense. But on the investor side, you lose some desirability, right? You don't necessarily get the 6 cap on an older building when you also have those responsibilities. So I think this one needs to be priced in that 7 to 7.25. Whoever's watching this, if they're the developer or investor or broker, probably they're yelling at me, but that's just the truth. That's how I feel. I think that a lot of urgent cares are priced in that 6 cap today, but that's a little too aggressive. Those are typically trading in the mid 6s. I expect this to trade around 7.25.
Yeah, and just to wrap that up, if we were to look at this, in that range, right? Let's assume we did buy this. I when I did the discounted cash flow analysis on this, comparing it to bonds, I always like to compare to bonds.
Yeah.
If I discount the income cash flows at 8% and the disposition at 8.5%, I get a recommended purchase cap rate of 7.36%, which is pretty close to in line with what you were saying, Winston, and also pretty close to looking at the comparable sales. If you can actually compare what those sales were, where I think it should be. So if you were to buy this at something like a 7.36, you'd be in for 1.45 million rather than the 1.8 asking. And you'd have a healthier investment, right? You'd be nearly 10% on your levered IRR. You'd be cash flow positive during the duration of your investment, and you'd be getting 2.2x on your money after 10 years. So yeah, I think we're pretty much in alignment there, that somewhere in that 7 to 7.2, 7.45 range is a more realistic price for this asset.
Yeah, and keep in mind, look, there's always a buyer, right, for every price. It's just a matter of how long they're willing to keep it on the market. So there may be someone out there who is in a bind in their 1031. They need to place this capital. They need to move their capital. They're going to buy it, right? But what we're saying is that if we're advising someone who is not currently in a bind, who is they have their capital, they want to make smart investments and not move too quick, then we would advise in that 7.4 range. Now, would they pull the trigger at that? That's a big difference, right? Moving 100 to 140 basis points is huge. However, in this environment, I think it's something to discuss with sellers. So, with that said, anything else, Tyler, on this one?
I think that's it, man.
Well, if anyone wants to talk to us about this property or any other properties that they may have interest in, we look at everything in the Southeast of the U.S. We do this daily, and we develop, buy, sell, lease commercial real estate, specifically in the single tenant net lease space. So give us a shout, contact me, or give Tyler an email or call, and we'll try to help you out. Thanks, Tyler. See you next week.
Thanks, Winston. Cheers, man.
Cheers.